Hello, everyone. I'm Miles. I'm happy to discuss basic concepts in investment banking. Today, we'll talk about a simple math concept which reveals how we price things for the future. It's a beautiful data formula. We use data to answer questions about the future. This might sound high level, but it's not difficult. As always, we'll use a soft-to-learn approach and learn by solving problems. Let's look at a simple question. It says, this value, accompanied by cash flow, the future cash flow, has been given to you as $100 per year, and this will increase by 5% each year. So, for example, at the beginning it's 100, the next year it's 105, and then the year after that it's 105 times 1.05, right? We don't have a calculator, but if you keep going like this, that's how it works for year 1, and so on, right? So in this situation, what does that mean? Basically, for a company like this, what is its actual value? There's actually a very simple formula for this. What is value? It's the cash flow that can be generated at the end of the first year, regardless of what kind of cash flow it is. Whether it's dividends or free cash flow, in other words, free cash flow. For now, we're not discussing the financial concept, we're just talking about the math calculation. So, it's like this, CF1 minus, divided by what? Our minus G, okay, our discount rate is 0.1. For simplicity, let's not discuss how this so-called discount rate is determined, we'll just use 0.1. And our G is 0.05. So, in this situation, in the first year, it's 100, which means 100 divided by 0.05, which equals 2000. It sounds pretty simple. Using this formula, the cash flow generated in the first year, you just put the so-called discount rate minus G in the denominator, and that's it. The solar value is 2000, so its value is 2000. But why do we use this formula? How is it derived? It's quite simple. It's something we've all learned before, a geometric progression, or in English, a geometric series. We've all studied geometric progressions. So how is this formula derived? We calculated it as 2000, but how could it be that simple? Let's take a look. In finance, especially investment banking, we often do these calculations. What we get is the present value, the current value of the flows. This is very simple. We discount predicted future cash flows, first, second, third year, back to the present. Money in the future is not as valuable as money now. We consider inflation and other factors, so we discount it back to calculate its current value. This is how we determine the value of the company. Now, since we already have this timeline, the end of the first year, the end of the second year, the end of the third year, and now, which is time 0, we need to discount each year's cash flow back to the present. Right, we have to discount them all back. After discounting, we know that for the first year, it's CF1 divided by 1 plus R, for the second year, it's divided by 1 plus R squared, and for the third year, obviously, it's multiplied by 1 plus R cubed. For the third year, it's not just 1 plus R squared, but 1 plus R to the power of 3. So, we add all these up, and once we do, you'll quickly notice, what is this? This is a geometric series, right? A geometric progression. When we sum all of these up, what does the sum equal? If it's an infinite series, as we all know, for a geometric series, if we have a 1q, and so on, continuing indefinitely, then the total sum is clearly a1 divided by 1 minus q. If it's an infinite series, this is a very common and simple mathematical formula that we all learned in high school. So, in this case, we already know what a1 is, right? Now, in our infinite series, what is the so-called ratio q in our geometric progression? Well, that's just this divided by that. We can see that if we calculate the discount, the ratio comes out to be 1 plus g. Just divide it, and that's the ratio in the geometric progression. It's very easy for us to calculate this ourselves. Just divide and you'll get it. So, under these first 5 points, we know the so-called present value, which is its sum, right? The total. So what does that equal? Well, that's it. The first CF1 divided by 1 plus 2 divided by 1 minus this q, okay? If you plug all these formulas in together, you'll quickly find that the conclusion you get is CF1 divided by 2 minus 7. I won't bother simplifying this formula because all the numbers are already here. Once you simplify it, you'll quickly see the conclusion. So, in this situation, we know that As long as the discount rate is greater than the growth rate, we can always use this formula, a very simple and elegant geometric series summation formula, to discount all future cash flows back to today and thus calculate the value of the company we're evaluating. In fact, in the entire investment banking industry or in modern finance, you'll often encounter calculations using this formula, so please make sure to remember it well. In other words, this is what we mean by the present value of a company. So what does that equal? It equals the first year's cash flow divided by R minus G. Of course, there are many assumptions here. As we discussed earlier, the cash flow must grow at a rate of G every year, and the discount rate must always be R. We assume both R and G are constants. This is the simplest and also a very elegant mathematical formula, a geometric series summation formula. This is widely used in investment banking and in all of modern finance. This is one of the most fundamental formulas. In the future, as we work through many problems and discussions, and as we encounter various concepts, we'll keep coming back to this very important tool for valuing companies. Okay, that's the formula for valuing companies. That's all for today's lesson. See you next time.